We've been on almost a 12-year bull market. At some point, we're going to run into that bear market. And today I'm going to talk about the 5 ways to capitalize on the next bear market. Hey everyone, lead trainer with StocksToTrade, Tim Bohen here, back with another trading video. Be sure to like, subscribe, share with your friends. We're doing a bunch of great stuff with the channel, lives, podcasts, long form, short form, tips, screeners, trade recaps, ton of great information. I want you all to see it. And if anyone you know is interested in trading, 2020 is a wild time, capping a 4-year amazing run and, like I said, a 12-year bull run. So share these videos, get your friends involved. There's never been a better time to learn trading. And speaking of that, if you're looking to take it to the next level, check out the Steady Trade team, where we do twice daily webinars, live, interactive, breaking down everything about trading, technicals, fundamentals, chart patterns, filings, the whole gamut, all in twice daily webinars. All right, that being said, let's get started. So I actually, I didn't realize, but my wife had just bought me a new shirt. And oddly enough, it's got a bear on it. So I was inspired, as she told me, I was inspired to wear this shirt and do today's video. So, man, like I said, ever since the financial crisis, and you can see a long-term chart in 2009, 2011 is where we really broke back out. So we're basically in a decade-long bull market. And let's talk about what the difference is. So a bull market is a steadily uptrending market, a market that's, the trend is up. And you can see that red line. Basically, I'm denoting a bear market. You can see, of course, stock markets and stocks, nothing goes up forever. Nothing goes down forever. Well, unless you're like a marijuana stock, then you go down forever. But, nothing goes up forever. Nothing goes down forever. But the overall trend, and obviously there's pullbacks here and there, but not hard to see. And especially if you take out, really that big pullback because of the coronavirus, which was a big pullback, and we were in a bear market for a while. But if you take out that, you smooth that line out, you can see we're steadily uptrending. Vice versa, a bear market is a steadily downtrending market. And I guess the best example I could give you is if we jump back to that 2007 area all the way down to 2009. That was a multi-year trend, and let me drop a line in for you. I know you can probably kind of see it, but here we kind of are in 2007, and you can see steadily downtrending. Just like with a bull market, there's deviations from the norm, but if you go top to bottom, you can see that the trend was lower highs, lower lows, just like in a bull market, higher highs, higher lows. So that was kind of the last time we really had a sustained bear market. Like I mentioned, this spring with coronavirus, a couple months, but here we are. I'm recording this in fall of 2020, and here we are back to a few points from high. Now, traditionally, when you're talking about a bear market, it's when stocks are 20% off of the highs, off of the recent highs. And we were there in March. But at the end of the day, it's just trends. That's the difference. And here we are, steadily uptrending market. So that being said, decade long. We're due. We're due. Now, I'm not one of those doomsday guys. I'm not one of the sky is falling guys, but stocks don't go up forever. And at some point, we're going to get a pullback. And let's talk about how to capitalize on that. So, number one, you're going to do that by short selling. And if you're not familiar with short selling, check out our other videos. We talk about it a lot, but I will briefly explain it. Basically, when you short a stock, when you go short, and this is confusing, but listen along, pay attention, and I'll break it down for you. You can actually borrow a stock and sell it before you buy it. Okay, that's when you go short, you take a negative position. So if you look at your brokerage account, you would have negative 1,000 shares of, let's say, Apple, AAPL. So vice versa, if you're long a stock, you would own 1,000 shares. So you would have in your brokerage account 1,000 shares of the float. Vice versa, when you short, you're borrowing them from your broker, who is borrowing them from a long-term investor, a big institutional investor that are holding them for years. And many of you might be saying, well, why would they lend them out? Well, there's fees. That's the biggest thing. So if you're, let's say you're a big hedge fund and your plan is to hold Apple for years, you can actually make money by lending out those shares with zero risk. There's really, there's no risk at all, because if there's a margin call, if the person borrowing them gets bought in, I mean, you're down nothing. It's almost like free money, for lack of a better term. There's zero risk when you're loaning out your shares, because you're only loaning them out. It's not like I can take these shares and, run away to Antarctica with them. If I go AWOL, you just get the loan back. You don't get paid your fees, but whatever. So zero risk for long-term investors. It's kind of a no-brainer. I mean, if I was a hedge fund, I'd be loaning out my shares like crazy, because the fees are huge. And we'll do a separate video talking about borrow fees and locate fees and, the percentage points. I mean, it's good money. So that being said, if you're a big investor in some of these companies, call your broker and say, hey, loan some of my shares out. I want that free money. Anyway, so now when you short that stock, you take a negative position. You are then buying back the shares to close out your position. Just like if you have 1,000 net and you sell them to go back to zero. With a short, you sell them, buy them back, you go back to net zero shares. Now, ideally, the stock goes down, and since you sold and then bought at a lower level, you collect the premium. Okay? I know it's confusing, but you're still buying and selling. You're just flipping them on the time frame. So take your chart and flip it or put it in the mirror, and that's the same idea. You're buying low, selling high for a profit. Now, vice versa, if you short up here and you buy back up here, you're paying, well, you're not paying, you're losing that premium. So if you shorted $1 and you buy back to cover at 10, you just lost $9 a share. So whatever that difference is, everything is just reversed. Now, I'm going to move on because we talk about shorting a lot. Keep in mind, one of the biggest things you got to be careful with is, listen, you hear me say it all the time. You have to have a stop. You have to stick to your stop. You can't break your plan. But that is doubly true when you're short, because in theory, now it's a theory, but you have unlimited potential losses. Because if you buy some junk penny stock for $1, all it can do is go to zero. It can't go below zero. So all you can do is lose $1 a share. So if you buy 1,000 shares of a $1 stock, your maximum downside is $1,000 if you get wiped out. Vice versa, you short 1,000 shares at $1, it can go to 2, you're down 1,000, but it can go to 3, you're down 2, it can go to 4, it can go all the way up. And if it goes to 10, you're now down $9,000 on a $1,000 position. Doesn't sound right. It's right, okay? You can check my math. So anyway, that's why you have to be extra diligent with your stops. All right, now let's move on. When? Okay, Tim, you spent a couple minutes scaring me out of not short selling. Let's talk about the how-to. So what do you want to focus on? The biggest thing, the biggest flyers, the biggest runners, the hot sectors, the stocks that have gone from 1 to 10. Because at some point there's going to be profit taking. At some point the sector's going to fade. I mean, I joked earlier about the weed stocks. I mean, weed stocks have just been on a long-term downtrend after spiking, a couple years ago, well, several years ago when Colorado legalized, and then a couple years ago again, well, about a year and a half ago, we had a big spike when it was a hot sector, but then all of them faded and became great shorts. So like I said, focus on the biggest runners, keep that stop, because the faster they run up, the faster they can pull back. Next thing I wanted to talk about is having patience. One of the biggest things that happens to short sellers is they enter too early and they don't wait for what we call that first red day. I mean, a great example of a stock from today that I was talking about in StocksToTrade Pro is JKS. I mean, look at this stock. I mean, this is an interesting idea. I mean, this is, I believe, the 17th green day in a row. This is not necessarily a great company. It's a solar stock, but 17 green days in a row. You have to wait for a sign of weakness. If you try guessing the top at 26 or 30 or 38 or 40, or today it hit a high of 46.40, you know, I'm sorry, yeah, 46.40. You can't try and guess the tops. You have to wait for that first red day. You have to wait for that cracking below support, okay? All these technical patterns we wait for. But, you know, there is no, everyone talks about trading like a sniper. If you're a short seller, you're an aspiring short seller, there is no better example of trading like a sniper, because what does a sniper do? He may sit there for hours or days waiting for his target. Okay, that sniper's waiting for that general to walk out of the bunker, and he doesn't get to go home. He doesn't get to go to lunch. He doesn't get to go home at the end of the day. He sits there and waits for that general to walk out, and it might be days. So that's what you have to do. You have to wait for that weakness. You can't guess tops. And, you know, I'm kind of curious. Drop me a comment below. We'll see when this gets published, and maybe when you're watching this. It wouldn't surprise me to see JKS have a huge pullback, you know, if you're watching this in November or December or maybe next year. At some point, the stock's going to pull back, but not today. So next thing is, don't try and fight the market. You know, I brought up this SPY chart, and we're not far from all-time highs. I want you to be prepared for the bear market, but we're not there yet. I mean, even you talk about the effects of a global pandemic. You know, this is the coronavirus was possibly a once in a lifetime event. I mean, we may never see, I hope, I mean, I guess my thing would be, I would hope we never see a situation like coronavirus again. But even then, market's back to highs. So I don't think we're ready yet, but it will come at some point. Don't fight the trend, though. It's not the time to short yet. Now, maybe back in March, you could get more aggressive, but wait for the trend to shift. Wait for that trend line to break, then start looking to get aggressive. Last thing I want to talk about is don't try and guess the bottom, okay? One of the biggest things with shorting that I see a lot of traders get in trouble with, and we'll go back to JKS, they get greedy, okay? And let's just imagine JKS went red today, okay? And it might, you know, it's still only 11:30 a.m., but if JKS turns red on the day, you can't sit there and wait. So 44.13 would be that red move. Now, what I see a lot of traders do, they get greedy, and they're hoping that this thing's going to pull all the way back to that resistance level at 24. You can't do that, especially right now, especially on the short side, okay? You can't try and hold for a $30 a share gain or a $20 a share gain. If you get a big 10% move to the downside, 20%, 30%, excuse my whiteboard, you take those profits and you move on, because we see so many of these stocks gap back. They'll issue a press release. Maybe there's a sympathy play. They run back. So don't try and guess the bottom. You're trying to take consistently repeatable trades that make you a profitable trader over time. You're not trying to hit a home run. That home run mentality blows up so many traders. So that being said, I got a question for you. When's the bear market coming? I know a lot of people have been predicting it for literally a decade. You know, I know a lot of hedge fund analysts, TV talking heads. I remember watching CNBC in 2009, and they're like, it's the end of the world, end of the world, end of the world. And here we are. Look at the difference between 2009 and today. So when is it? Give me your prediction below, and definitely subscribe and share with your friends, and check out the Steady Trade team, and we'll see you next time.